The 1950s are calling to tell us that the safest income source isn't bonds. Want to know what it is? And should we get that? In just 5 years, Canadian bonds lost a quarter of your purchasing power, while a basket of Dividend stalwarts doubled in price. When inflation ran nearly 20%, core bonds fell 4.5%. That's a real hit of minus 25%, a silent tax on savers. Our grandparents, they faced the same combination of high debt and capped yields. Governments then kept interest rates below the inflation rate to shrink debt. Bonds bled, while so-called widows and orphan stocks, utilities, pipelines, and telcos, they became the safe harbor. Fast forward to 2025. Ottawa's deficit path, it's doubled. And interest costs are just one budget cycle away from overtaking healthcare transfers to the provinces. The temptation for the Bank of Canada to hold rates beneath inflation is back. I remember Elaine, one of my first clients, lived on dividends. She absolutely loved her blue chip stocks. When I pitched lower risk bonds, she laughed in her British accent and said, "I don't like bonds." 10 years after her passing, the numbers prove she was right. So what should we do as investors? Well, first, consider swapping part of long bonds for high dividend, high quality stocks. Now, in doing that, the second point is that we're going to have to accept some price swings to avoid guaranteed real losses. So we're going to need to manage that volatility. Third, we need to stay tactical. Adding bond duration, that time will come when bonds finally pay yields above inflation. Look, investing isn't easy. It's always a balance between holding fast to what's worked in the past and updating assumptions based on changing conditions. Currently, the data and history says it's time to rethink the comfort of bonds. I'm Glenn Evans from Evans Family Wealth. If you'd like to talk about updating your investment assumptions, reach out. We're here to help.